Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about the new stimulus measures that have been introduced by the Chinese central bank to try to get the economy kick-started again. At the beginning of 2024, the expectations were high, and the Chinese authorities set a growth target of 5% for GDP in the year. However, over the past 6 months, we've seen the economy slowing down significantly, and it's now no longer expected that China will hit that 5% target, and how low it comes in remains to be seen. And what we are seeing is a reduction in demand in China itself. We're also seeing a continued problem with the property sector, which has been going on since 2021. And in the month of August, we saw new home prices falling at their fastest rate for 9 years. So the problem is actually getting worse. And we're also seeing companies in China struggling with regards to the prices that they're selling their goods at. Over the past 18 months, there has been a month-on-month decline in producer prices. And all of these factors are now weighing very heavily on the Chinese economy. So to try to address this, the Chinese central bank have introduced a variety of different initiatives, including reducing the reserve ratio at some of the biggest banks, which means that they will no longer have to hold as much cash in reserve. So therefore, they can free up more cash for lending, so they can give more money out into the economy. They've also cut the rate for borrowing for existing lenders and reduced the amount that you have to put down as a deposit if you're buying a home. So in today's video, we'll take a look at that extensive package that's been announced by the Chinese central bank. We'll talk about what's going on in the economy right now. We'll have a look at some of the data that's been released for August, including retail sales, inflation, producer prices, and what's happening with regards to the property market. And then finally today, I'll wrap up with my summary as to what I think is happening in the Chinese economy right now, and whether or not this package of stimulus measures is enough to be able to turn things around and get China back on track for that 5% growth target. But before we get started on all of that, I'd like to say once again, thank you so much to everybody that's supporting the channel. Really do mean this. If you're a long-term supporter, either through Patreon or Buy Me a Coffee membership or YouTube membership, thank you for that long-term support. And as I've said before, I've got some members who've been with me for more than 2 years, which is really quite amazing. Thank you so much to every single one of you, even people who just sign up. Really, really appreciate it. And if you've bought me a coffee or sent me a YouTube super thanks recently, thank you so much for the time and the effort and the generosity involved in that. Really means a lot to me. The Chinese central bank has introduced its most comprehensive stimulus package since the ending of the COVID-19 pandemic in an effort to try to get the Chinese economy back up and running again. Now, with regards to the package itself, it's split broadly into 2 different categories. We've got measures that are targeting the banks, trying to get them to lend more money to release more cash into the economy, and we've also got measures that are targeting the property sector directly. Now, when we're talking about banks, all banks around the world have regulators, and those regulators say that banks need to keep some cash in reserve to cover them in the event of some sort of disaster. And in China, it's referred to as the Reserve Requirement Ratio, or RRR. And the central bank has just announced that the RRR has been cut by 0.5%. So that means that the banks can release some cash that they previously were holding onto. And it's estimated that this cut will release around 1 trillion yuan back into the economy in the form of new loans. So it's hoped that those loans will be given out to lots of companies and individuals, and those individuals and companies will then spend that money, and that will help to keep money moving and encourage people to go out and start spending more. They're trying to get both businesses and consumers in China to spend more, because at the moment, Chinese people are being very conservative. We're seeing a month-on-month fall in retail sales, and we'll have a look at that later in the video. In addition to changing the reserve requirement, the Chinese central bank have also cut the MLF, which is the cost of medium-term borrowing to the large banks. So that means that the cost of loans has gone down, so it makes it cheaper, and therefore also should encourage corporates and individuals to take on more debt. And both deposit rates and the reserve repo rate have also been cut. So what that means is that if you're holding money in the bank, you'll now be paid less interest. And so this discourages people from just keeping all of their money in the bank and encourages them to take it out and start spending. So the central bank has introduced a variety of different initiatives to try to get money flowing through the economy. But one of the biggest problems that the economy has faced over the past 3 years has been the significant fall in the property sector. And it's estimated that currently 70% of all of Chinese net worth is held in property. So what that tells us is that in the period prior to 2021, when we saw a turn in the market, a lot of people in China were putting virtually all of their life savings into property, either buying their own home or second and third properties as an investment. And as the market has come down and prices have fallen, obviously people are feeling less wealthy. And also that money is very illiquid. It's very difficult to be able to get your cash out because the secondary market in China is really quite depressed. And in order to try to stimulate that market, the Chinese central bank has just announced that local authorities will receive a 100% guarantee from the People's Bank of China when they buy property in the secondary market and turn it into social housing. And this was an initiative that was introduced around 12 months ago by the Chinese authorities to try to get the property market kick-started again. They wanted the local authorities to start buying up all of the property that was on sale and then renting it out. However, the local authorities didn't want to do that because the market kept falling, and they were accountable in terms of any of the losses that were made on those purchases. However, this new initiative basically moves all of that risk to the People's Bank of China. So basically the state, because the People's Bank of China is owned directly by the state. And so this is providing a total guarantee for all of those local authorities. So what the authorities want here is the local authorities, the local governments, to go out and start buying up everything in the market. That will then free up funds for all of the people who are trying to sell those apartments. They then get some cash back. They may feel more wealthy, and so they'll start spending again. And in addition, the central bank has also announced that the deposit required when buying a second home has now been reduced from 25% to 15%. And again, this is designed to encourage people to go out and buy more property. But the big question is, will people actually want to buy property? Well, let's talk about what's going on with new home prices, because that will give us a flavour as to whether or not people are now feeling more confident about what's going on in property or if they are still very cautious. This chart shows the year-on-year movement in new house prices in China over the past 12 months. And new house prices are absolutely critical in China because the vast majority of people want to buy new property. They're buying things off plan. And this has been a really big problem in the market over the past few years because if you follow the channel, you'll be aware that many of the big developers, including Evergrande, ran out of cash because they had all of their debt cut off by the authorities following the introduction of the 3 red lines policy. And as a result of that, they were unable to finish those apartments. And many people in China have been left with mortgages without actually having any apartments at all because it hasn't actually been constructed. So we start off by having a look at the situation 12 months ago. In August, September and October 2023, new house prices fell by 0.1%, which obviously isn't a great outcome. If you're a builder, you want prices to be going up. You want people who are signing up before you've built it to be happy that by the time they move into that property, the price has gone up and therefore their home is worth more than they paid for it. So a fall of 0.1% wasn't great. However, if you look at what's happened over the course of the following 10 months, 0.1% actually looks quite good. In November, the fall in house prices doubled to 0.2%. It doubled again in December to 0.4%, increased to 0.7% in January, doubled to 1.4% in February, increased to 2.2% in March, 3.1% in April. Prices fell by 3.9% in May, 4.5% in June, 4.9% in July, and in August 2024, the year-on-year fall in house prices was 5.3%. Now, clearly, this trend is highly concerning both from Chinese consumers' perspective, who are owning property, but also from the Chinese authorities' perspective, because property constitutes around 25% of total GDP in China. And if we widen the scale of this graph to show what's been happening over the past 13 years, which is the maximum amount of data that we have available, you can see that the current fall in prices of 5.3% is actually the worst that's been experienced in China since 2014, and in fact is the second worst in the whole of its history. And if this trend continues, if we continue to see house prices falling month on month, this could be the biggest crisis that has ever occurred in China's history in terms of the property sector. And as I've just said, as it constitutes 25% of GDP, that represents a serious problem for China trying to achieve its GDP growth target of 5% for 2024. And this is one of the main factors that's pulling down the Chinese economy right now. So let's have a look at what the impact of these falling prices has had on new home sales. This chart shows the year-on-year movement in new home sales in China, and the scale on the right-hand side of this chart goes from 0% at the top to 65% negative at the bottom. And as you can see, in every single one of the last 12 months, there has been a year-on-year fall in new home sales. In August 2023, new home sales were down by 33.9%. There was a minor recovery in September and October when the year-on-year movement fell to 27.5%. However, over the following 4 months, new home sales fell again, and by February 2024, the year-on-year movement was down by 60%. And as I've just discussed, when you're talking about a part of the economy that contributes 25% of GDP, this is an absolute disaster. Now, in the second quarter of 2024, there was a minor improvement, and by June 2024, the year-on-year movement was down by 17%, which at face value doesn't look anywhere near as bad as the 60% fall in February. However, if we change the scale of this chart to show the situation dating back to February 2022, so the last 2.5 years, you can see that the 60% fall in February 2024 was compared to the 14.9% increase in sales that was seen in February 2023. So when we're talking about year-on-year movement, you always have to look at what happened in the previous year to see whether or not that was a particularly strong year or a particularly weak year. So in order to put the 17% year-on-year fall in sales into perspective in June, we need to look at what happened in June 2023. And you can see that year-on-year, sales were down by 28.1%. So the 17% fall in 2024 is actually in addition to the 28% fall seen in June 2023. We're comparing this year's figures against what the situation was last year. So really the 17% doesn't reflect how serious the fall was in June. And if we look at the latest data for August 2024, new home sales were down by 26.8%, which is clearly a terrible result in isolation. But when you consider that the year-on-year position in August 2023 was a fall of 33.9%, we've got a cumulative impact. And in fact, if you look at the situation for August 2022, there was also a fall of 32.9%. So over the last 2 years, there has been a complete collapse in new home sales in China. And this is one of the main reasons why the economy is in such a dire situation at the moment. This chart shows the year-on-year movement in retail sales in China, which is a good measure of consumer spending. It tells us whether Chinese consumers are wanting to increase their spending or decrease it. And the scale on the right-hand side of this chart goes from 0% at the bottom to 11% positive at the top. And what we can see here is that in August 2023, retail sales increased year-on-year by 4.6%, which is obviously below the target of 5% growth that's been set by the Chinese authorities. However, in the following 3 months, there was a significant increase in retail sales, and by November 23, they were up year-on-year by 10.1%, which is more than double the target of 5% growth. So happy days from the Chinese authorities' perspective. However, as you can see, over the past 9 months, there has been a significant fall in the growth of retail sales. In December 23, the year-on-year increase reduced to 7.4%. No figures for retail sales are published in China in January, but in February we saw the growth falling back to 5.5%. It then fell to 3.1% in March and 2.3% in April. There was a bounce back in May when year-on-year growth increased to 3.7%. However, it fell back to 2% in June, 2.7% in July, and the most recent figures for August show that year-on-year retail sales increased by 2.1%, which sounds okay. However, when you consider that China needs to hit a growth target of 5% for 2024, 2.1% is a long way behind that target. And what it tells us is that Chinese consumers at the moment are very cautious, they're not spending, and therefore the economy is really slowing down. This chart shows the year-on-year movement in industrial production, so how much China is actually producing each month. And this again is a very important metric because China is a big manufacturer. It's the heartbeat of the Chinese economy. It needs all of its manufacturing businesses to be growing at least 5% in order to hit that target of 5% GDP growth. And in fact, when you consider that the property market is in such a dire situation, it's likely that manufacturing will need to compensate for the fall in the property sector. So it should be achieving more than 5% growth. And one thing to note here is that the scale on the right-hand side doesn't start at 0. It actually starts at 4.3% and goes up to 7% positive at the top. So what we can see here is that in August, September and October, the growth in industrial production was relatively low at 4.5 and 4.6%. We then saw a significant increase in industrial production in November, December and February 2024 when it got up to 7%, which is probably around the level that China would need it to be at in order to hit that 5% GDP target. However, in March, we saw a significant fall in the growth in industrial production to 4.5%. It bounced back to 6.7% in April, reduced to 5.6% in May, 5.3% in June, 5.1% in July, and the latest figures we have for August 2024 show that the year-on-year increase is 4.5%, which is below the 5% GDP target and is significantly below where China needs it to be in order to hit that target for the full year of 2024. So once again here, we've got another worrying sign that China is falling off the pace and isn't going to come in anywhere near its target. If China isn't able to grow through its own domestic market from retail sales, then the other option it has is through its exports. And this chart shows the year-on-year movement in Chinese exports over the past 12 months. And what this chart shows is that back in August, September and October 2023, the situation was really dire from China's perspective. And in October, the year-on-year movement in exports was down by 6.6%. China did manage to reverse that situation in November, December and January when year-on-year exports were up by 8.2%. However, the situation quickly reversed in February and March when the year-on-year movement was back down to 7.5%. But over the past 5 months, the movement in exports have moved back into the black, and the most recent figures that have been published show that year-on-year exports are up by 8.7%. And at face value, this looks like a great outcome from China's perspective and is ahead of that 5% GDP growth target. However, as we've just discussed, when you're talking about a year-on-year movement, you always need to take into account what happened last year. So if we change the scale of this chart to show what's been happening over the past 3 years and have a look at the situation for August 2023, you can see that year-on-year, exports were down by 8.4%. So if we take that into account when looking at the growth of 8.7% in August 2024, the net movement over the past 2 years has been an increase of 0.3%. So you always have to be really careful when you're looking at percentage data to take into account what you're comparing it against. Because, as I said, at face value, growth of 8.7% seems fantastic. It's well ahead of that 5% target. But actually, when you take into account the fact that exports collapsed this time last year, and we're comparing the movement now against that collapsed figure, the actual growth isn't that strong. And this is, again, one of the problems that China is facing right now. It hasn't managed to bounce back significantly to offset the poor performance during 2023. This chart shows the year-on-year movement in imports in China. And the reason that imports are important is that China imports a lot of raw materials, which it then uses in its manufacturing processes. And so it gives us an indication as to how strong the pipeline is for Chinese businesses. If they're importing a lot of goods, then that means that they're bulking up, they're buying in lots of things in order to produce things and then sell them. If they're reducing the amount that they're purchasing, then obviously that tells us that there's a fundamental problem. And what this chart shows is that in August 2023, year-on-year imports were down by 7.2%. And over the last 12 months, it has been a really mixed bag in terms of the year-on-year movements. In 5 out of the last 12 months, China has seen a fall in the level of its imports, and it's only seen an increase in 7 of those months. However, some of those increases have been quite small. And the most recent data for August 2024 shows that the year-on-year movement in imports is only up by 0.5%. However, when you take into account the fact that in August 2023, there was a 7.2% fall, that 0.5% increase actually shows a 6.7% fall against the figures for 2022. So once again, you need to take into account what's happening last year when you're looking at the percentage movement this year. And these figures tell us that Chinese industry hasn't sorted itself out. There isn't a major boom that's around the corner. We're not going to see a huge bounce back in the level of imports and the amount that's being sold. And so there's a fundamental problem here. And one of the other issues that Chinese business is facing is what's going on with the price that they're selling their goods at. This chart shows the year-on-year movement in producer prices, which, if you follow the channel, you'll be familiar with. They're also referred to as the factory gate prices. So this is the price of goods as they're leaving the factories in China before they're sent to the stores. And what this shows is that in every single one of the past 13 months, there has been a year-on-year fall in producer prices. In August 2023, producer prices were down by 3%. And the latest figures that we've got for August 2024 show that year-on-year, they were down by 1.8%. And as we've just discussed, that is compared with the situation from August 23, when prices fell by 3%. So when you add together the cumulative impact of those two movements, you've got a fall of 4.8% against the prices from 2022. Now, when we're talking about producer prices, this is really important because it tells us whether or not companies in China are increasing their profits or whether they're now struggling. And the fact that producer prices fell in August 23 and August 24 tells us that year on year, factory gate prices are going down. Companies in China are now selling their goods for less than they were 2 years ago. And that's obviously an absolute disaster because the cost of all of their purchases have not been going down. Over the past 18 months, we've seen high levels of inflation all around the world, and those rates of inflation apply to a lot of the commodities that China have been buying. So Chinese companies' costs have been going up at the same time as their sales prices have been going down. So what that tells us is that profits in China have been reducing, and it's estimated at the moment that potentially 40% of all companies in China are making losses. They're not actually making any profit. And as we talked about earlier in the video, one of the biggest problems they have is that the retail market in China is in the doldrums. It's not growing sufficiently to be able to sell enough goods. So China's having to export more. There are more costs involved in export because obviously you've got to pay for transport. There are potential exchange rate issues with regards to selling in yuan or dollars or euros or whatever it might be. And so this is another problem from Chinese companies' perspective. And when you look at the situation for August 2024, it's actually getting worse. The year-on-year movement in July was a fall of 0.8%. However, the 1.8% fall in August represents a significant deterioration in that situation. And if that trend continues, then it's likely that the situation will get worse for Chinese businesses and therefore the Chinese economy. So what's the summary and conclusion today? Well, I wanted to post this video because I think the announcement by the Chinese central bank of the stimulus package that's designed to get the economy going again is interesting for two reasons. Firstly, it's the largest stimulus package that they've announced since the ending of the COVID-19 pandemic. So that tells us that they're trying to address a big problem. And secondly, it's an acknowledgement by the Chinese authorities that there is a serious issue in China right now, and that it's unlikely that China will hit its 5% growth target for 2024. And if it doesn't hit that target, the big question is, how low will it come in? Will it come in 4.7, 4.5, 4%, or even less than that? And the problem that China has is that it's a growth economy. It needs to keep growing at a rapid rate just to keep the lights on, to keep everything going. So 4.5% growth would actually be a complete disaster from China's perspective. And what we've seen in today's video is that the data is telling us that the fundamentals are not looking good from China's perspective. We've got a serious slowdown in terms of industrial output. And industrial output is the heartbeat of the Chinese economy. That's what China does. It manufactures things and sells them both to its own people and also all around the world. And what we saw from the data earlier is that the slowdown in industrial output is coming at the same time as retail sales are falling in China. They're now down to growth of around 2% compared with that 5% target. So China isn't driving its own growth, and so it's now reliant on exports all around the world. But there are questions over what's happening in the global economy. So China is looking quite fragile right now. And the Chinese central bank's package, I think, is really interesting because rather than trying to stimulate growth, they've targeted lending. They've freed up some capital for the banks to encourage them to provide more debt for people to then borrow and then go out and spend. But what we're seeing from retail spending is that consumers are very cautious. They're not going out and spending a lot of money. So it's unlikely that they're going to borrow and then use that borrowing to go out and spend. What they're doing instead is saving their money. They're sitting tight on their cash. So I don't think that the stimulus package that's been announced is going to tick all of the right boxes, because what people don't need in China at the moment is more debt. What they want is for the economy to be growing, for people to be being paid more, for output to increase, for sales to increase, and everything just to become a lot more buoyant. So I don't think the Chinese authorities have targeted the right part of the economy. Now, in terms of the property sector, as we've talked about many times, that equates to around 25% of GDP. And it's been a major problem for China over the past 3 years. They've been trying to fix this problem, but it simply looks unfixable at the moment. And what they've announced is that the local authorities now have a 100% guarantee if they go out and buy property in the market. So we may well see a boom in those local authorities actually doing that. However, the devil is in the detail in terms of what the ultimate risk is. At face value, it looks like the People's Bank of China will cover any failure in the value of those properties. However, unless it's actually stated that that is the situation, we may well find that the local authorities are cautious because the local authorities have a huge amount of debt already. I've talked about this in other videos. It's around $9 trillion. It's an absolutely monstrous amount. So whether or not that fixes the property market remains to be seen. But what we have seen in today's data is that house prices are continuing to fall. And in fact, the rate at which prices are falling is accelerating. It's now the highest for 9 years and is close to being the highest ever in China's history. And that tells me that people will remain cautious. If I'm watching house prices constantly falling month on month, the last thing that I want to do is dive into the market and start buying because it hasn't bottomed out yet. So the fact that they've made it easier to buy second homes by reducing the amount of deposit required from 25% to 15%, I don't think that's going to fix the market, because all that means is that people would need to take on 85% debt. And if you want to take on debt right now, it would be a really big risk, because when you take debt on, you want the price of your property to go up. If it's going down, all that means is that you're likely to end up in negative equity. You could end up with a loan that's worth more than the value of your property. So I don't think that the measures that the Chinese central bank have introduced will either fix the property market or fix the economy. So the overall summary of today's video is that the package that's been introduced by the Chinese central bank is the largest that they've introduced for the past 3 years. They're desperate to try and to turn things around. However, I don't think that the measures are going to fix the problems. The fundamental issues remain in China, and it's likely that they will come in significantly below their 5% growth target for 2024. And this could effectively result in a recession in China. It wouldn't technically be a recession because they would have year-on-year growth in GDP, but in relative terms, this could be the most serious situation that the Chinese economy has seen at any time in the last 20 years. And if that happens, unfortunately, it will have a knock-on impact to the global economy because China is the second biggest economy in the world by some way, and it purchases lots of things. And if it's in decline, then that will have a direct knock-on impact to lots of other economies. And we could see some serious problems starting to occur all across the world as a result of China's slowdown. So I'll keep you posted on any further news and developments as and when they occur. Hopefully you found today's video useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.